Good day everyone, I'm Jimmy, and if you are new to this channel, welcome. If you are not, thank you so much for supporting us all this while. Just remember that every like and subscribe goes a long way in supporting our production. Now, before we dive into today's video, have a look at these disclaimers before we proceed. So, you must be wondering, where's Marcus? Well, he's indeed busy with his work these days, and we have to apologize upfront for the lack of content for the past 3 weeks. You see, things are starting to pick up. Getting up for work in the morning and interacting with friends and family seems like an abstract concept for 2020 after being in a lockdown situation for months. With the little time that we have left, we apologize for the lack of updates, but here are we with a new video. Gosh, I must have forgotten how important it is to be constantly updated with the latest news. But you know what? I've been diligently reading the papers, scrutinizing the headlines for a while now. Medical stocks bullish run, stocks from certain industry tanking, though things aren't quite the same before this COVID pandemic struck. But every day, we are hearing the same cycle of news. Optimistic one like the tech stocks running into all-time highs, medical industry being in huge demand, and the slightest hope that these headlines give to the world that a vaccine could be developed in weeks with positive breakthroughs. However, the V-shaped recovery that we all hope for isn't probably going to pan out, since no vaccines have yet to be discovered and corporations are reporting huge losses for the second quarter of 2020. Even some are desperately trying to stay afloat with share buybacks, and some are still issuing rights and securing loans from government institutions or banks. So, where are all the investments or monies that investors and traders are going to park in? True enough, there's an aspect in the market that was undervalued for quite some time. Something that has withstood the test of time and proven time and time again that it will be in high demand in such trying times. Commodities, and in specific, gold. Something that women adore, as they could be shaped into beautiful little trinkets that could be flaunted with or enhance their overall outlook. Sometimes even bringing out the shimmering nature of diamonds in a few exotic pieces of jewelry ever created are worth as much as the GDPs of a few small countries. Just take a look at a few of them. And before I forget, something that men would also wish they could have more to store as their excellent stores of value when used to hedge against inflation and during deflation as people choose to hoard cash over tough periods. Historically, gold started off as a means of trading of goods and services and has slowly evolved into the paper notes and currency we have today. To know more about the history of gold and how it has been pegged to the currencies that we have today, please do check out a video by Economics Explained, which in our opinion is very informative and also goes on to review more about the system of global banking that we have today. Alright, so before we dive into the topic, firstly, we need to understand the hype around this special commodity. The prices of gold fluctuate because of two reasons: normal market forces based on demand and supply, and speculation based on external market forces. Addressing the former, government vaults, central banks, and investment pressures mainly drive the demand for gold. Governments and central banks buy gold because they have a sole responsibility to promote stable economic growth. The ability to buy and sell gold helps central banks control their market growth. Similarly, governments will use their market excesses to store into a medium that will prevent widely fluctuating currencies and damaging industries as a result. Thus, developing countries like China and Russia see their governments actively buying into the metal and storing into their vaults. In fact, just last year, China has been actively adding tons of gold into its vaults in an attempt to protect itself from the trade war fallout with the US so that its currency would not depreciate against the dollar that rapidly. As of today, the amount of gold reserves that China amassed is roughly about 2,000 tons, slightly dwarfed by the 3,000 tons that the US Department of Treasury have stored majority of their gold in Fort Knox, Kentucky. For the latter, investment pressures from growing demand for jewelry and electronics kept the bullish run of gold, as emerging markets such as China and India accounted for approximately half of the demand of gold for jewelry. Culturally, gold is synonymous with prosperity and wealth in both India and China, hence explaining why gold grew in popularity as these markets develop. Moving on, investment pressures from the manufacturing sector for electronic devices, for example, medical purposes, i.e. stents, and precision tools like GPS units require these precious metal for production. As 7.5% of the demand goes to the demand for industrial and technological productions in 2019, we believe that there is room for further growth as technology advancements in a recent decade would see more high-tech instruments being produced that require tiny amounts of current to operate in the nanotechnology sector, and a plus would be its resistance to corrosion and oxidation, unlike other metals like copper or silver. To address the latter, speculation based on external market forces will come in the form of investor sentiments in both the paper value of fiat currency and the overall outlook of the global economy. In the 1970s, when central banks abandoned the gold standard led by US President Richard Nixon, which meant that paper currencies were no longer exchangeable for gold. If you look up Investopedia, the gold standard would enable countries to agree to convert paper money into a fixed amount of gold. A country that uses the gold standard sets a fixed price for gold and so-called buys and sells gold at that price. And that fixed price is used to determine the value of the currency. This was necessary because there were too many dollars in the international system and too many countries exercising their rights to exchange them for the US gold reserves. So after Richard Nixon's decision, currencies became fiat, meaning that countries could freely decide how much to have in circulation, hence leading to the rise in monetary policies such as the quantitative easing that we very well experience today. Hence, fiat currencies refer to a country's value of currency having value not because that they are backed by gold, but because the arbitrary value that the state standing behind them said that it possessed. Well, not so arbitrary to an extent, as the currency we own today are all fluctuating dynamically against other currencies in the foreign exchange market, forex, based on world news that affects countries and the speculation of forex traders based on the news that they receive. So to put it simply, the confidence one has on one currency against another at any point of time in the day based on the daily events of what's happening is how currencies work today. But what has it got to do with gold? Just like how currencies are traded in the forex, trading of gold through the equity or future markets are popular ways to diversify one's wealth. An ETF that tracks gold such as the SPDR Gold Trust shares that has got the greatest market participation in all types of market environments and that has got an average daily trade volume of 14 million since March 2020 would be one way. Or buying gold options that entails considerable amount of risk unless calculated, which would be a game of greed and fear as one looks at the trends coupled together with technical analysis of the market. This brings me to the next factor that could potentially affect investor sentiments, the overview of financial markets. Whether it's going through a recession or a bullish run would definitely affect the prices of gold. In such trying times amidst the global pandemic, we have seen the bullish run on prices of gold entering the 1800 mark a few weeks back, and as of today, just recently broke the 1900 mark as many investors and traders flock to invest or speculate the prices of gold after the crash of the stock market in March this year. Needless to say, it comes as no surprise because a moment of deja vu will jolt one's memory back to the 2008 global financial crisis when the investors and traders ran for the hills in search of another safe haven for their nest eggs and cash. It was gold that also saw a bullish run of close to 100% since 2012 as the Fed's approach to the crisis was an unprecedented quantitative easing that inevitably devalued the dollar after introducing $4.5 trillion into stimulating the economy again. Hence, the million-dollar question is, are we seeing history repeating itself again? No doubt that there is a strong buy signal in the equity market for gold, investors also look to long gold futures, as seen from the COMEX Gold Futures that represents the world's leading benchmark future contracts for gold prices for July and August, which continues their bullish runs. Looking at our domestic market, based on the data from Enterprise Singapore, domestic exports of non-monetary gold accounts for nearly one-third of the NODX growth in the first quarter 2020. However, it grew at a slower pace at approximately 0.7 billion Sing dollars or 27.1% than in previous quarters, in which in the fourth quarter of 2019 at approximately 1.8 billion Sing dollars, or the third quarter of 2019 at approximately 1.4 billion dollars. To explain more on NODX, it refers to the non-oil domestic exports and comprises of electronics and non-electronics, in which we have been focusing a lot on gold for this video. To jog your memory, at the start of the video, I mentioned that gold is integral in the production of electronics. As Singapore is a small domestic market that is heavily reliant on exports and imports, the X-M for those economics students, NODX grew further by 12.5% in May 2020 after the 0.6% decrease in the previous month. Integrated circuits, short form ICs, which form the bulk of the growth, which is 90% of the electronic NODX, these media products and these drives grew by 22.5%, 51.5%, and 23.6% respectively, contributing the most to the growth in the electronic NODX. This further bolsters the bullish pressure on the prices of gold, as companies will expect a greater demand for electronic components as the technology wave surges in the midst of this period of uncertain times for business sectors. If you were to zoom out and look at the macro view of NODX on a global scale, US increased by 50.6% in May 2020, following the previous month's 124% expansion, led by non-monetary gold, these media products, and silver platinum metal. In Asia, NODX to Japan climbed by 52.9% in May 2020, following the 81.1% expansion in April 2020, and contributing to its rise are specialized machinery and PCs. While all of that is going on, NODX to Taiwan rose by 27.2% in May 2020, following the 28.1% growth in the previous month, mainly due to ICs and non-monetary gold. So, if you were just to look at the statistics, it would just be the dry part. But it will point to us that the growing interest in gold is not purely based on speculation, adding in the fact that it is also a good medium to prevent inflation as the US dollar weakens due to the unlimited QE. It is gradually due to the tech wave that we are riding on in the 21st century. While we are on it, please do check out one of the videos we made back then detailing the consequences of printing too much money. No surprise, as tech companies were already on a bullish rise before COVID-19 period, but the global pandemic lifting the sector off, leaving the broader market to recover from its March lows, as the electronic industry will capitalize on the rising price of gold and continue to ride on the tech wave as well. According to a US Geological Survey in 2011, there is approximately 0.034 grams of gold in each cell phone. There will be approximately 2 USD at the time of creating this video. Hence, Apple, Samsung, and Huawei, just to name some of these large electronic companies by revenue, may continue its wave of raking in large amounts of profits as a result of improvements in technology, and perhaps the rising demand for gold in this new technology might be one of the factors contributing to it, as the push for more efficient gadgets and software ensures a fiercer competition between these electronic companies. Since there's an increased demand leading to a rise in the price of gold, to ensure that the prices of electronics remain competitive amongst various competitors, corporations could either employ various business techniques, for instance economies of scale, or enforce their brand loyalty to attract more customers as they grow their customer base or reduce their cost of production. This leads to other companies producing spare parts, for example integrated circuits, nanochips, or microprocessors, just to name a few, for them to be more competitive and in turn look into the ways of obtaining cheaper materials of production for these particular products. And so, in the next part of this series, we are going to look into how such producers are going to source for cheaper gold where the prices are skyrocketing now. By increasing the supply of gold in the economy will provide a downwards pressure on prices, which will mean that corporations will definitely be looking into the ground for ways to get their hands on more gold. That's it for today's video. Again, I'll be definitely flattered if you have one key takeaway from this video which you can share with your other friends. Leave any questions you have in the comments and both Marcus and I will try our best to answer them thoroughly. Stay tuned for the next part of the video and invest safe.